Usually when we look at massive, unbelievable wealth, we expect to see some kind of magic trick.
Oh, completely. You want it to be a trick.
Right. Like you expect a sudden inheritance or maybe a winning lottery ticket.
Or, somebody founding a tech unicorn in a garage overnight.
Exactly. You see the billions and you just point and say, well, they hit the jackpot.
Right. It's always comforting to view extreme wealth as a stroke of lightning.
Yeah, because it means we don't have to hold ourselves to that standard, Lightning is entirely out of our control.
Exactly. But when you step into the world of long-term value investing, that lightning strike is, well, it's nowhere to be found.
Nowhere.
We are looking at a financial landscape that is built entirely on the relentless, unglamorous mechanics of compounding over decades.
Okay, let's unpack this, because today's deep dive is custom-tailored for you to explore that exact engine.
Yes, it is.
Our grounding source today is a really fascinating piece of financial history. It's excerpts from the Weschler Blueprint, Compounding Millions from a Modest IRA.
Such a great source.
It really is. And our mission today is to dive deep into the astonishing true story of Ted Weschler, the man behind that account.
And what an account it is.
Seriously.
Yeah.
I mean, going from a $70,000 individual retirement account to a staggering $264 million fortune.
It sounds completely made up, but it's not.
It's not. We are going to extract the concrete strategies and the intense psychological resilience required to achieve this kind of growth.
Which is key, yeah.
Right. Our goal is to separate the actionable advice you can actually use in your own life from the extraordinary outlier events that make his specific story so unique.
And it is an incredible journey we are mapping out for you today. We are going to start with a junior analyst's very modest beginnings in the 1980s.
Very modest.
Yeah, and then examine a devastating 52% market loss that honestly would have terrified most people out of the stock market entirely.
It would have ruined me, I'll be honest.
Right. And then we'll explore the audacious move of paying millions of dollars just for a lunch date.
Which is wild.
We'll also look at the sheer nerve required to voluntarily hand over a $28 million check to the IRS.
Ouch.
Yeah. And finally, synthesize what all of this mechanical discipline actually means for your own financial toolkit.
So to truly understand the magnitude of this $264 million fortune, we first need to look at how this highly private financial information even became public.
Right, because this is not something he published in a newsletter.
No, not at all.
Yeah.
We only know about this account because of a massive, unprecedented data leak.
The ProPublica leak.
Exactly.
Yeah.
In June 2021, the investigative journalism group ProPublica released their secret IRS files report.
Which was huge news at the time.
Oh, it was everywhere. They had obtained federal tax returns and exposed exactly how some of the wealthiest Americans utilized the tax code and retirement accounts to build enormous wealth.
And it is absolutely crucial that we look at this leak objectively because the source material presents two entirely different lenses on the exact same numbers.
Right.
ProPublica highlighted this as a structural flaw. They argued that the tax code currently allows the ultra-wealthy to shield immense wealth in vehicles like IRAs.
Which were originally designed by the government to aid average working-class families in their retirement.
Exactly. Their reporting was a systemic critique. But conversely, Weschler's response focused entirely on individual mechanics.
He kind of leaned into it.
He did. He used the leaked data as an opportunity to demonstrate the mathematical power of early compounding to young investors. So two entirely different lenses on the exact same financial reality.
Right. And we aren't here to take a political stance on tax policy or decide who is right.
No, definitely not.
We are just analyzing the mechanics of how the wealth was actually built. And that brings us to the origin story, which is the part I find absolutely mind-blowing.
It really grounds the whole thing.
It does. We are going back to 1984. Ted Weschler is a 22-year-old junior financial analyst, and his salary is just $22,000 a year.
Which is a very standard, modest starting line.
Extremely modest. Even adjusted for inflation, it's still a very typical entry-level corporate salary.
Right. There is no massive trust fund being deposited here to kick things off.
None. And he didn't do anything magical or complex at first. He just focused on the absolute basics. Think of it like a financial planting season.
I like that analogy.
Yeah, from 1984 to 1989, he maximized his contributions to his employer-sponsored retirement account, and he made sure to take full advantage of his employer matching program.
Which is huge.
Wait, let me just pause on that employer match concept because it's so easy to gloss over.
People ignore it all the time.
All the time. If your employer offers a 4% match, And you put in 4% of your salary, you are getting an instantaneous, guaranteed 100% return on your investment before the stock market even opens.
It is literally free money.
Exactly, free money.
Right.
By treating it that way, over just 5 years, he grew that account to $70,000.
And we really need to emphasize this point for you, the listener. That initial $70,000 is the absolute foundation of this entire story.
The bedrock.
Yes. Without this disciplined, entirely mundane early saving phase, the later astronomical compounding would have been mathematically impossible.
Because you need something to compound.
Right. The math of compound interest strictly requires a principal amount to work its magic on. It's essentially a high-performance engine. You have to spend years meticulously building the pistons and the block before you can ever add the rocket fuel.
And he spent 5 years just building the engine.
Exactly.
But having a $70,000 nest egg doesn't spontaneously make you a multimillionaire.
Sadly, no.
The transition to astronomical wealth required Weschler to change the structure of his investments. So he took that retirement savings and converted it into a self-directed IRA.
A very big step.
Huge. This meant he was no longer choosing from a tiny, curated menu of standard mutual funds provided by an HR department. He took total, unrestricted control over every single investment decision.
Which is a tremendous amount of freedom, but we have to remember that with absolute freedom comes absolute exposure to risk.
Oh, yeah.
And in 1990, the market tested him severely. His newly self-directed account plummeted. He lost 52% of its value.
Wait a second, let me just stop right there.
Sure.
Because if I log into my retirement account tomorrow and 52% of it is simply gone, conventional wisdom says my strategy is deeply fundamentally flawed.
Most people would agree with you.
Right. Why shouldn't you, the listener, view that as a massive failure on Weschler's part? Isn't that absolute proof that he had no idea what he was doing and just got lucky later?
What's fascinating here is how his psychological framing diverged completely from standard human instinct.
How so?
The source specifically notes that Weschler did not view these losses as failures. He actually coined a specific term for them. He called them unmonetized lessons.
Unmonetized lessons.
Yeah.
Wow. That is a wild way to look at losing half your net worth.
It's a brilliant way to process a setback, though. Think about it. When you lose half your portfolio, the human brain goes into fight or flight mode.
Total panic.
Yes,
Yeah.
the natural evolutionary instinct is to sell everything, salvage whatever cash is left, and retreat to absolute safety.
Just hide the money under a mattress.
Exactly. But Weschler analyzed the mechanics of the loss instead of panicking. He treated the evaporated funds as the literal tuition fee for an incredibly valuable education in market dynamics.
So he didn't lock in the panic, he extracted the data.
Precisely.
And what he learned clearly fueled the strategy he used for his subsequent legendary run.
Oh, absolutely.
Because if we jump ahead a bit, from 2000 to 2011, while he was running his own hedge fund, he achieved a remarkable 22% average annual return after fees.
For over a decade.
For over a decade.
Yeah.
To put the mechanics of that in perspective for you, the broader stock market generally averages somewhere around 7 to 10% depending on the time frame. Doing 22% year over year is staggering.
Yeah.
So how exactly did he pull that off structurally within this IRA?
Well, the source breaks down his investment philosophy into 3 core mechanical pillars. First is deep granular research.
Meaning he wasn't just skimming the news.
Right. He wasn't casually trading based on headlines or momentum. He rigorously studied business fundamentals. We are talking about diving incredibly deep into balance sheets, understanding a company's competitive advantages, and evaluating the quality of their management.
Real detective work.
Completely. He was looking for a company's intrinsic value, the true mathematical worth of the business, and waiting until the market panicked and priced the stock significantly below that intrinsic value.
Okay, so he's buying heavily discounted quality. What's the second pillar?
Concentrated bets.
Oh, really?
Yeah. The traditional advice you always hear is hyper-diversification. Buy hundreds of different stocks, so if one fails, you're perfectly safe.
Don't put all your eggs in one basket.
Exactly. But Weschler did the exact opposite. His philosophy was essentially to put his money into a very small number of highly researched companies.
That seems risky.
It does, but mathematically, if you are truly right about a valuation, diluting that winning stock with 99 mediocre companies just drags down your overall return.
Right, but that strategy assumes you are almost flawlessly right about those few companies.
It requires extreme conviction, yes.
Which I assume brings in the third pillar,
Yeah.
long holding periods.
Precisely. He held these concentrated positions for extended periods of time, allowing the businesses to grow and the market to eventually recognize their true value. But more importantly, doing this inside an IRA allowed him to maximize the tax advantages of that specific wrapper.
I love this concept. Let's really break down the mechanism of tax advantages here because this is massive for anyone investing.
It's the secret sauce.
There really is. In a normal brokerage account, if you buy a stock, it goes up, and you sell it to buy something else, you immediately owe capital gains tax on that profit.
Yep. The tax man comes calling.
Right. The government takes a 20 or 30% slice of your gains every single time you rebalance your portfolio. It's like an engine that constantly leaks fuel.
That is a great way to put it.
Over 30 years, that leakage suffocates your compound growth. But inside the traditional IRA, those trades happen in a tax-deferred bubble. He could buy a stock, hold it for 5 years, sell it at a massive profit, and reinvest 100% of that profit into the next idea.
Zero leakage.
Zero leakage.
Yeah.
No tax drag at all.
That uninterrupted, frictionless compounding is exactly why the account scaled so violently. The math was allowed to work in a total vacuum.
Here's where it gets really interesting, though.
Okay.
Because building wealth with an incredible investment strategy is one thing. But protecting that wealth and setting it up to scale into the hundreds of millions requires some radically bold, almost counterintuitive life choices.
You're talking about 2012.
I am. Weschler made a massive move in 2012 when he executed a Roth conversion.
A monumental and very painful decision.
Let's explain why. With the traditional IRA, the money grows tax-deferred, meaning you don't pay taxes while it grows, but you will eventually pay ordinary income tax on every single dollar you pull out in retirement.
Right.
When you convert that account to a Roth IRA, the rules invert. You pay the taxes on the entire balance right now up front out of your own pocket, but then the account grows completely tax-free ever. Because his account had grown to over $100 million by 2012, making this conversion meant he voluntarily handed the IRS a check for $28 million.
It is an agonizing amount of liquid money to part with voluntarily.
I can't even imagine.
Most people cannot fathom taking a multi-million-dollar hit to their current liquidity for benefit they might not fully realize for decades.
It really is taxing the seed versus taxing the harvest. Think of it like buying a lifetime VIP pass to an amusement park while the park is still under construction. You are paying an exorbitant, painful fee up front. You're emptying your wallet at the gate. But you are doing it to ensure that every single ride, every single dollar gained from that point forward for the rest of your life is completely protected.
It's a brilliant move if you have the cash.
Right. By paying the toll up front, he essentially sealed the engine. From 2012 onward, it compounded into $250 million without the government ever taking another drop.
It is the ultimate example of long-term, tax-efficient thinking. He understood the trajectory of his portfolio, and paying $28 million then was a mathematical bargain compared to paying taxes on hundreds of millions later.
A total bargain in hindsight. And that exact mindset, that willingness to pay a massive upfront cost for an asymmetrical delayed reward, completely explains his most bizarre move.
The lunches.
Yes. Because in 2010 and 2011, Weschler paid a total of $5 million at charity auctions. And he didn't buy real estate or art.
No, he did not.
He bought lunch. 2 lunches with legendary investor Warren Buffett.
Yes, the famous Glide Memorial Church charity auctions.
Wait, if he is a pure value investor, someone who is completely obsessed with finding intrinsic value and avoiding waste, spending $5 million to eat a sandwich with another human being seems completely irrational.
On paper, yeah, it seems crazy.
Unless he viewed Buffett himself as an undervalued asset that he simply needed access to.
That is exactly the deduction to make here. If we look at the trajectory of his career, that $5 million gamble was not just a generous charitable donation.
Right.
It was arguably the most successful, calculated networking expenditure in modern financial history.
That's a bold claim, but it makes sense.
It does. The source highlights that during those lunches, Buffett was profoundly impressed by Weschler. He was impressed by his intellect, his philosophy, and his deep mechanical understanding of value investing.
So impressed that the payoff was a massive career shift.
Exactly. Buffett actually hired Weschler in 2012.
Wow.
Yeah, he brought him into Berkshire Hathaway as an investment manager to handle their large cap investment.
And just to clarify that term for you, large cap simply refers to the stock of major, highly valued corporations typically companies with a market capitalization of $10 billion or more,
To big leagues.
the biggest leagues. So Weschler essentially paid $5 million to buy a job interview at the absolute pinnacle of the investing world, and he aced it.
He really did. It was a perfect execution of treating a relationship as a high-conviction, concentrated investment.
So what does this all mean for you? Because it is incredibly easy to listen to this story and just dismiss Ted Weschler as an extreme outlier.
Sure.
The guy gets 22% annual returns, writes a $28 million tax check, and drops $5 million on lunch.
Yeah.
How does a billionaire's playbook apply to a listener who is just trying to optimize their standard 401k and definitely cannot afford to buy Warren Buffett a sandwich?
This is where the source provides the perfect bridge.
Okay.
When reflecting on his journey, Weschler himself acknowledges that his specific path is extreme.
Very extreme.
But he points out a stark, reassuring mathematical reality. If we connect this to the bigger picture, if he had never researched a single stock, never started a hedge fund, never bought a concentrated position, if he had simply taken that original $70,000 account in 1989, dropped it into a standard S&P 500 index fund, and walked away.
Let me guess. The math still creates a fortune.
Exactly. By 2021, that completely untouched index fund would have grown to approximately $1.6 million.
$1.6 million. Just by letting the basic mechanics of the American economy work in the background.
Just letting it ride.
And an index fund, for those wondering, is simply a basket of stocks that automatically tracks the performance of a broader market, in this case, the 500 largest companies in the U.S. No deep research required, no $5 million lunches.
Precisely. The extraordinary, highly concentrated bets took him to $264 million. But the fundamental laws of compounding guaranteed that he would be a millionaire regardless, just by packing the snowball early and letting it roll.
Which leads perfectly into Weschler's core rules for normal people, straight from the source. They are brilliant in their simplicity.
They really are.
Number one, start early. Give the engine the decades it needs to actually run.
Time in the market.
Right. Number two, maximize those employer matches. Because as we establish, that's instantaneous free money.
Never leave free money on the table.
Never. Number three, invest 100% in equities. He believes in the long-term productive growth of actual business ownership, which is what stocks or equities represent, rather than holding cash or lower yield bonds.
Makes sense.
And number four, avoid distractions from market noise. Just tune it out.
And there is a vital caveat to his advice that we must include.
Like that.
While Weschler champions deep, rigorous research for his own concentrated bets, he strongly recommends low-cost index funds for investors who lack the time or the inclination to dissect balance sheets.
Which is most of us.
Exactly. He is actively proving that for the vast majority of people, simplicity often beats complexity. You don't have to be a stock-picking genius to win the game. You just need relentless consistency.
It really comes down to the mechanics, not magic. To wrap up today's deep dive, what we've unpacked is the ultimate proof of concept for long-term investing.
Absolutely.
It's the sheer power of starting early with whatever modest means you have, protecting your money from tax drag, and having the absolute ironclad discipline to let compounding do the heavy lifting over decades.
Even when the market tests you.
Especially then.
It is a blueprint built entirely on time and temperament.
Before we go, a quick reminder from our source material. If you want to keep following along for lots more investment info and advice, make sure to open the full version of the source and follow us on Spotify.
It really helps.
It does. Consider subscribing to get more quick tips and updates, since one click is all it takes to make sure you never miss out. Also, share this deep dive with others who might find it helpful, and thank you so much for your support.
This raises an important question, something for you to mull over as you go about your day.
Let's hear it.
We've seen that the tax code mathematically allows a standard $70,000 middle-class retirement account to legally scale into a $250 million tax-free fortress.
Which is still hard to wrap my head around.
Right. So looking at Weschler's journey, are we looking at an inspiring tale of brilliant individual discipline, or the ultimate proof that the rules of finance were written specifically for those with the patience and capital to exploit them?
Wow. That is something to think about.
Yeah. The math is simple, but his psychology is extraordinary.
If an index fund alone could guarantee $1 million retirement for the average person, perhaps the biggest barrier to immense wealth isn't our ability to pick the right stock. Maybe it's our ability to stomach a 52% loss and
Yeah.
humbly call it an unmonetized lesson.
Exactly.
The lightning strike is a myth. The real magic is just knowing how the machine works. Thanks for joining us on this deep dive. We'll catch you next time.